Okay, so in today's lecture, we'll talk about mutual funds. And in the last lecture, what we have done was we covered, there are five kinds of mutual funds: equity, hybrid, debt, solution oriented, and others. Now, this classification has been given by SEBI way back, I think, in 2017, and they wanted to streamline the mutual fund industry. So they said that henceforth there will be five kinds of mutual funds, so that the people who are investing, they have a clear idea, where their money has been parked. So the first one which we did was equity. Now within equity, we have various funds like large cap. You can see there's a circle on the large cap. So large cap fund, then mid cap funds, then small cap funds, then multi cap funds, contra funds, ELS, ELSS, focused funds, large and mid cap, dividend yield fund, value fund, mid cap fund, and then sectoral thematic fund and flexi cap fund. So altogether there are about 3 into 4, 12 funds. Now we know the large cap funds are basically the funds where all your money has gone into the top 100 shares of stocks of India. So if you can just read these mutual funds. Now what I did was I went to ChatGPT and asked about all these funds. So let's understand what the ChatGPT says about these funds. So this was basically equity fund features. Okay, so basically, if we talk about each fund, a multi-cap fund, I said first is the large cap, where it invests in well-established companies with large market capitalization, top 100 companies by market cap, and we all know what are those companies. We can just go to Screener to find out what are those companies, and then we say Nifty 100. Okay, so Nifty 100 would be these companies whose total market capitalization is given here, which is 2 crore 77 lakh 50,000. Currently the index is at 26,000, and the P ratio of the top 100 companies in India on an average is 22.1. Okay, then price to book ratio is 3.43, which means all the companies in India on an average trade at a price to book ratio of 3.43. Now if historically this has been the average, it has been hovering around 3.4 to 3.5. So we say the Nifty is, fairly valued. But suppose it goes tomorrow to 4, then we say the Nifty 100 large cap funds are overvalued. Okay, so the price to book ratio is basically to observe whether the stocks at the index level are overpriced or underpriced. Then the dividend yield of all the 100 companies is 1.33%. Now, what's the formula for calculating the dividend yield? It is the dividend paid by the company divided by the market price per share of the company. So that's why the dividend yield falls to 1.33. Okay, and not the exact dividend paid in terms of percentage on the face value. It is on the market value. So on the face value, the companies may declare 25%, 30%, 100%, but this dividend is actually on the market value. This is what you're getting every year by investing your money in the stock market. Now, if you look at the last few years, like last 1 year, Nifty 100 has not given any returns. So CAGR 1 year is minus 1.49%. Whereas for the last 5 years, the same figure is 17.4%. So it is given a very good return of 17.4%. And then CAGR for 10 years is 12.4%. Now, if you want to look at, what are those companies which are, there. So this is, all the top 100 companies. So we will have, 1, 2, 3, 4, 5. So 100 companies are listed out here. So we can just download and, even have our own analysis done. Now, if you look at this chart, okay, so I'm just removing this 50-day moving and this thing. So in the last 1 year, if you see, the stock market has been, kind of on a consolidation phase. It has neither moved up nor gone down. So there was a time when the market started falling after October and then fell till February, and then again started going up. So it has reached to the level almost, it was 27,000, and today it is around 26,000 or 26,000. So it is, almost at that level at which, it started its journey in October. Even it is less, about 1 or 2%. So there was a dip in between, and then the stock market has started picking up after the GST announcements. The market is showing some kind of a pickup again, and then if we have the 50-day and a 200-day moving average also imposed on this price graph, then we say that the stocks, that the Nifty 100 large cap company as a whole is trading above both its 50-day moving average and 200-day moving average. So which is a good sign that we are in a bullish zone. Now it all happened around here. If you look at this point, when the Nifty was 25,381, and it was 8th of May when the crossover happened. So this was a kind of a golden crossover. After that, it gave a confirmation that the market is on uptrend. Of course, the market started moving a little bit earlier because the moving averages are lag indicators, so they give you a confirmation after 15 days or 2 weeks or 3 weeks. So it may take some time, okay, for the moving averages to cross over and give a confirmation that the market is now in a bullish zone. So the market has remained above 200-day moving average. Twice it was testing the 200-day, so this becomes a support now for the market. And similarly for 200-day, so this is 200-day moving average, so it is now acting as a support. So market, whenever it tries to goes down, it again goes up from that level. So it's expected the market should do well in the coming months and reach to all-time high. So let's go back to the large cap fund. So this is the large cap fund. Then we have the mid cap funds. So invest mostly mid-sized companies ranked 101 to 250 by market capitalization. Offers higher growth potential than the large cap, but comes with a higher volatility. Now, mid-cap funds are ranging from 101 to 250 in terms of market cap. So they are slightly riskier compared to the large cap stocks, but they have a more potential to grow and give higher return. So investors who have a high risk appetite, they must invest into mid caps. Now, the small caps, they focus on small companies. They have a market cap beyond 250 companies in India. In terms of market cap, so all companies from 250 onwards, maybe it will be 251 till 10,000 companies which are listed on the stock exchange. So all will coming under a small cap. Now they have a very high growth potential, but they come with a lot of risk. So the investors who have who are aggressive and who wish to take higher risk but want to have a higher returns, but they should park their money for it's written here around 7+ years. So let's go back to now this so let's go back to this thing. So we have the large cap funds. So if we go to the large cap funds, then we'll find here these are all the large cap funds. So we are now going to talk about direct plans. Now whenever you buy funds, you can buy directly from the fund house by going to their site, or you can buy regular plans, that means buy from a broker. But it is always advisable to buy directly, because there you are not going to pay the commission, the trail commission, which around is about 0.5% to 1%. So you are going to lose that amount. So what we do is we download the data. Okay. So we download all the chart and we have this information on with us. Okay. So what we did was we actually deleted all this, the first paragraph, the first row we deleted. And then we deleted the plan, the direct plan, because all are direct plans, so we don't require this information. All are large caps, we know that. So since we have downloaded only large cap, so then what we do is that we just shade all this and do Control T, and my table has headers. Yeah, it has headers, so I just click it and then change the color. So then we have all these funds in a file where we can always do our analysis. So let's look at if you're putting your money in large caps, particularly in equity markets, so you should always look at a return which is around 10-year or or 5 year or 3 years to find out which is the best mutual fund. Okay, so what I'm doing is that I'm making all this zero. I could have copied it, but anyway. So then I can just sort them again from largest to smallest. So we know that in a 10-year time frame, the top performing fund is Nippon India Large Cap Fund. It's a direct plan and growth fund. Now, it's a growth fund. I'll tell you what is a growth fund. And there are two categories, growth and dividend. So we should always put our money in a growth fund and not in dividend, because dividends are taxable every year. So this fund is a 5-star rating fund with asset under management of 45,000 crores. That means, all the amount which has been invested in this fund is to the tune of 45,000. Now, in 1 week, it has given 1%, 1 month, 2%, like this. For 1 year, it has given 4%. Okay. For 2 year, 19%, 3 year, 21% CAGR, and 5 year and 10 year. So the fund has given 16% in, on a period of 10 years. And there are some more funds which have given the same kind of a return, like Canara Robeco and ICICI Prudential Large Cap. So they are all given 15. But if you look at the 5-year return, Nippon is a far superior fund which has given 26 fund. So if you have to analyze and see which fund you should put your money, by going by the past track record, the Nippon tells you that it is the best fund, and then followed by either between ICICI or Canada. So you can choose any, but then you have to just sort them the 5-year also and see which fund has done better. So we can do that. So these funds don't have a history for the 5 years because they are new funds. So that's why they don't have any number here. So I'm putting them 0 so that I can sort them and see which fund has given the maximum return. Okay. So on a 5-year time period, so it is ICICI Prudential, and then followed by HDFC Large Cap, then Invesco. Okay. And then if you have to see the 3-year, then we can just sort it on a 3-year basis also. So there are some funds which have not given, they don't have a track record for 3 years, so we can just make them 0. So on a 3-year horizon, the fund which has given the best is again Nippon. So Nippon is actually giving, for on all time period is giving the best, followed by ICICI Prudential. Let's see in the last 1 year which fund has done the best. So the last fund which has done the best in the last 1 year time frame is, I think, Motilal Oswal. Okay. So we need to find out, how Motilal Oswal has given 10%, whereas all other funds are either 4 or 2. Now, as we were going through, this fund was, started maybe in the last 1 year only, after the market had taken a dip and market started going up thereafter. So this fund could capture all the positive returns. Okay. And so that's why this fund has given 9%, probably because of that. But other, funds, they also have grown in this period, but they are still lagging behind. So, so this is what we covered last